What's going on, team? Welcome back to another week. Welcome back to another Money Monday. Hopefully, you guys are doing well. Hopefully, the market has been treating you very well. We have been seeing a massive, massive run up in the overall market, in the NASDAQ, in the S&P 500. But will it last? That's the big question. And what is really driving this market rally to continue? If we look back at yesterday's or last week's economic data that was released, we actually didn't get too much good news. So this is last week's data that we received Monday. We didn't have too much going on that was worth mentioning. Tuesday, core retail sales were as expected, actually a little lower than previous, which was 0.5%. And then retail control month over month was 0.7, higher than 0.3, which was expected. However, retail sales month over month was actually lower than expected, 0.4%, 0.8 was expected. That didn't do too well. That was pretty much the biggest thing on Tuesday. Wednesday, what we saw was crude oil inventories was 5.04 million, which is a lot more than what was expected, and a lot more than previous. So you can look at that in the way that I guess you're trading oil or energy sector. And then on Thursday, initial jobless claims, 242,254 was expected. So less initial jobless claims. So that's the only thing that I would say that was positive. And continuous jobless claims was actually a little bit lower as well, but not too much more than, 10,000 is relatively small in the grand scheme of things. So it is good news, but not enough to really justify the rally that we've been seeing here over the last week and a half to 2 weeks. And then Friday, we didn't really have too much going on. We had just a bunch of speakers speaking. If you guys watched last week's on Saturday, I posted the Fed speaker, Jerome Powell. He had a discussion about some of the key economic issues that the country is facing. You guys can check that out. I'm going to link that right up here. If you guys haven't watched it, it's definitely a good discussion to watch. It was a panel, definitely very interesting. On Thursday as well, we had existing home sales, 4.28 million. 4.3 was expected, again, slightly lower than what was expected. So less homes being sold. Again, not a very positive thing for the overall market. And we've pretty much been seeing something like this over the last 2 weeks. We haven't been seeing great data. So the question is, what is driving this rally? What is the market reacting to that's causing the market to continue? This week, we have some data coming out as well. We have building permits coming out on Tuesday, services PMI on Tuesday as well, and new home sales as well on Tuesday. Today is Monday. We didn't really get too much data. We had some speakers speaking today. Definitely something to pay attention to and keep track of. Wednesday, what we have is crude oil inventories. That's the big one, and the FOMC meeting minutes that are going to be released. Those are good to pay attention to. Thursday, we have continuing jobless claims. We have initial jobless claims as well. We have core PCE prices. We have GDP quarter over quarter. And we have pending home sales being released on Thursday. Those are the ones to pay attention to. They're probably going to help move the market. Again, the data hasn't really been the driving force of the rally that we've been seeing. And what we have been seeing is related to something else that we're going to talk about a little bit later in this video. Core durable good orders on Friday, month over month. Core PCE price index month over month for the month of April. Two big ones to pay attention to. And then some more minor ones to pay attention to on Friday. This is actually a pretty busy Friday. Goods trading balance, PCE price index, month over month and year over year. Personal spending month over month. Retail inventories ex auto to pay attention to. And I would say that's about it for this week. So pretty full week of economic data to be released. But again, what is driving the market to continue to rally? And that is something that we actually talked about in last week's video, in Monday's video. So if you guys haven't watched that, again, I'm going to link that one right up here. And that is actually the debt ceiling prices that we are dealing with. So if you guys watched last week's video, I actually talked a little bit more about what is going on. In this video, I'm just going to give you guys a quick recap. Essentially, we have the debt ceiling that we have approached. We are actually very close to actually going over it. And what that means is, in essence, we're going to be, as a country, we're not going to be able to pay our debts. We're not going to be able to pay our federal employees. We're not going to be able to take care of Social Security, Medicaid, Medicare, military. There's going to be a lot of problems that come up if we do default on the debt. And so last week, what we were talking about was we were supposed to see that, President Biden and Speaker McCarthy was supposed to sit together and discuss basically a resolution to how they were going to agree on increasing the budget. And in essence, basically what it is McCarthy is saying that, hey, we don't want to increase it if we're going to be spending money on X, Y, and Z. And President Biden saying that, we want to increase it, but we want to spend our money on X, Y, and Z, right? So it's just a matter of what we should be spending our money on and what we shouldn't be spending our money on. And that really comes down to them trying to figure out an agreement of, hey, we're going to spend money on this, but we'll cut back on this. And it really comes down issue by issue of them figuring that out. There are 2 articles that I did want to go over. And just a couple sections I wanted to read about. I'll link these articles in the description so you guys can check them out and read through them all the way, just get a better idea of what's going on. But the sections I did want to read about was the mere prospect of defaulting could breed economic turmoil long before the Treasury actually runs out of cash. Among the more alarming possibilities, Fitch Ratings and Moody's Investors Service have signaled that they could place the country's credit under review if Washington strays too close to default. In 2011, a similar standoff between House Republicans and President Barack Obama prompted the S&P to lower its rating of U.S. debt, sending the Dow plummeting and ultimately costing taxpayers more than $1 billion in higher borrowing costs, according to the Government Accountability Office. We do expect investors' concerns to mount as the X date approaches, particularly if there's no solution and the sides look wide apart, said Jonathan Pingle, the managing director and chief U.S. economist at UBC. So in essence, what we talked about last week was they were supposed to have a sit down and they were supposed to start working it out and trying to come to an agreement. On Friday, they actually didn't come to too much of an agreement and they actually stalled those negotiations. And today, on Monday, they were actually supposed to come back together. President Biden was at the G7 summit out in Japan. So he ended up returning to actually try to fix the situation so that, the debt ceiling we don't default on, right? They did come back and they are both agreeing, both Republicans and Democrats are agreeing that defaulting is not an option. And it's just a matter of who's going to give and who's going to, come to the middle and really work out a great deal that both sides are happy about. So it really comes down to that. And there's really not much that we can do and not much we can predict because it's not really in our hands. It's really in their hands to decide on what they're going to be spending money on and what they won't be spending money on. So at the end of the day, we just have to wait and see for that decision to come in. And what I believe is driving the market is the anticipation that an agreement will be reached. But as we saw in this article from the Washington Post, the closer we get to this X date, which some are saying is June 1st, some are saying is June 8th or 9th, and that's in essence when we run out of money completely. And so when that happens, that's when the problem really hits home. This article obviously said that the closer we get, the more nervous investors and traders are going to become. And so in essence, that's going to drive the market down lower. And so it was a very similar situation happened in 2011 and the Dow plummeted. So did the S&P. So what we want to talk about today is where we're at in the overall market, go over some technicals, and obviously go over both scenarios. Now, is the market going to continue rallying if they do resolve the debt ceiling crisis? That really just depends. Sometimes, they say buy the news and then sell the results, or, buy the hype and sell the news, right? So once that decision is made, the market can still pull back. So it doesn't really matter in terms of what we think is going to happen. We just have to be prepared for all scenarios. And that's kind of what we do in these Money Monday videos, in these weekly stock talks, is we talk about where we're at from a technical standpoint, where we're at from a fundamental standpoint, things to pay attention to, levels to pay attention to, and get you prepared to make the decision once everything sets up according to your plan, right? Everybody has a different plan, everybody has a different strategy, but those levels, those fundamentals, they're all the same for everybody. So being aware of that, making you guys aware of that, getting you guys prepared is what our job is here. And so if you guys enjoy these kind of videos, make sure to like this video, subscribe, share it with a friend. That way they're more prepared. And overall, everybody in the community is just going to become more informed, more prepared to take on the market in this upcoming week. So that's in essence what's going on. And one thing I did want to share with you guys is that the US debt has actually risen regardless of who holds the office, right? And who's in charge of the administration. We've actually seen it go up from 10 trillion back in 2010 to 30 trillion over just the last 10 years. And now we're raising the debt ceiling yet again. If you guys ask me, this actually looks like quite a parabolic chart. And so it's actually, it's scary, and it's actually not very comfortable to pay attention to. But regardless, the point is the debt ceiling still gets raised, and it's just a matter of, what do these both sides come to an agreement on so that they can avoid a bigger catastrophe, right? So let's go ahead and jump into the charts and talk about where we're at from a technical standpoint. So I'm going to grab my drawing tool. And one thing I want to note right off the bat, we're looking at the daily chart here. And this is QQQ, which is the NASDAQ. It's an ETF for the NASDAQ. And that's one we pay attention to. And it correlates very similarly to the S&P 500, which is SPY, SPY. So, regardless of which one you're paying attention to, they're both going to be reacting in a very similar fashion. This is just the chart that we pay attention to and what we go off of. So the first thing I want to note for you guys is that we're actually at this 338.67 zone. And we approached that just over the last 2 days, Friday and Monday today. We didn't make too much progress today, so most of that progress was on Friday. But one thing I do want to let you guys know is that we're actually at this resistance level, and it's actually a resistance level because of where we were at in August of last year. And we were actually at the same exact area where we got rejected. And if you guys note, the RSI was overbought. We're extremely overbought here. So from the previous setup, we got rejected at this zone, and we ended up seeing selling pressure, and then we ended up seeing the convergence on the MACD. Very similar setup to what we're potentially seeing happen right now. So in the case that we do begin to approach that X day, whether it's June 1st or June 8th, we're actually 10 days away, right? Or they have 10 days to figure it out so that they can have enough time to write it up, proofread it, and pass it so that we can avoid this catastrophe, right? And so we might flirt with this resistance for some time, but if the closer we get to that date, the more likely we're going to start seeing a sell-off, not just from a fundamental standpoint, but because we're also very, very overbought on the daily chart, right? And so once we start seeing that selling pressure kick in, it's very likely that we might come back down to this zone right here at this 313 zone, where we found support for quite some time. We actually consolidated. If you guys have been watching this channel, you guys know that we have been in that consolidation phase for quite some time. And I've been saying that if we do break above it and we hold, we would be looking to jump into TQQQ, which goes up when the NASDAQ market goes up. And that's actually exactly what we said. In the previous videos, we did talk about this previous resistance being a resistance if we do see that run up happen. And that's exactly what we're seeing right now. So those are some things I do want to note on a daily chart. Now, if we do pass that debt ceiling increase, can we potentially see a break up to the upside? That's really going to come down to, are we going to break above this level, come down, test it, and hold it before we continue higher? Or are we going to get rejected now? Or are we going to break up and then get rejected as well? So it really comes down to us making sure that we hold this support level if we break above it. If we do use this as a resistance and it does break down lower, we're probably going to head down to this next support level at 313, which it was a previous support, a very strong one to say the least, over the last pretty much, I would say, 2 months. So definitely something to pay attention to. And this is just on a daily chart. I do want you guys to be aware of where we're at in the grand scheme of things. Previous resistance is where we're currently at. We need to see a break above that and a hold for us to continue higher. If we don't see that, we're probably headed back down to 313, which is a very, very likely scenario. We've seen us sell off right after we maxed out here on the RSI, approached 70, maxed out, saw a sell-off, approached 70, broke above it right over here. Not the same resistance, but we're looking at just the pattern of the RSI. Every time we came over 70, saw a sell-off, right? And then came up to 70 once again, right up here, and saw a sell-off happen once again. Now we're at 70 once again or above, and we're at this resistance level again, potentially going to see a sell-off. Now, whether we see it down to this 320 zone or the 313 zone, it really depends on the economic data that we just went over that is coming up this week and how close we get to that X date, right? And so the closer we get, the more likely we're going to see that sell-off to these levels. So 313 to 320 is what I'm looking at as a potential short play. We are very overbought. The MACD hasn't started converging yet, but you know, with everything else lining up the way it is, I wouldn't be surprised to see it line up to actually have us see a sell-off. So that is kind of what I'm being prepared for. I'm preparing for the market to see some sort of pullback because we have been on quite a rally without seeing a significant pullback for some time now. So we are very overdue for a pullback. And on top of that, the fundamentals are adding up to us potentially seeing a pullback and the technicals as well. Now that is on a daily chart. I do want to go over a smaller time frame for you guys just so that you guys can see, you know, the way we kind of do an analysis. Now let's go ahead and jump into a 4-hour chart. We are very, very overbought on the daily chart. Now on the 4-hour chart, how overbought are we? Are we extremely overbought as well? And to that response is yes, we are. And we've actually started to see a sell-off happening on the MACD, not so much on the RSI yet. So we'll see how it goes. But again, at the same resistance that we just saw on the bigger time frame, having a hard time breaking above it and holding it. The first time we did that, we actually saw us break right below it. Right after we did that, right over here, broke below. Now we're trying to break above it again. And it's just a matter of, are we going to hold this level or are we going to break below it again? The big thing we're watching here is this blue line, which is the exponential moving average. And we're watching that on all time frequencies. MACD, we have actually seen that convergence already happen. And now are we going to continue to see it or are we going to reverse back to the upside? We are very overbought on the 4-hour. So again, very likely that we're going to see a sell-off. We're very overbought right over here. What did we see? We saw a sell-off. We were extremely overbought right over here. What did we see? We saw a sell-off happen. Now we are very, very overbought again, and it's very likely that we might see another sell-off. And considering that we're at that resistance again, and considering everything that we talked about on the daily chart. So that's the 4-hour chart for you guys. Now let's go ahead and jump into even a smaller time frame on the 15. We didn't see too much action happen today. We were pretty much choppy and flat all day today. Friday, we actually saw some selling pressure happen. Thursday was the big day that we saw that that pop to the upside. But today we pretty much opened up here at this 337 zone, and we closed at about 337.64, which is where we're at right now. So for the most part, it was all just chop, as you guys can see. Thursday, we saw a nice rally, pulled back to the EMA, rally continued. Friday, we saw selling all day, and today we saw chop all day. Not too unusual for a Monday, so tomorrow is going to be a little more exciting. The more data we start having coming out, the more exciting. Also, we have earnings coming out, so pay attention to those. But that's pretty much it for the technical breakdowns. Overall, I am not looking to be going in a long position at this particular point, just because we are at this very significant resistance zone. Now, if we break above this resistance zone and we see a hold above it, then I'll be considering a potential long entry in TQQQ for a rally to this next level of resistance right over at 370, I would say. But that really has to come down for fundamentals to line up and for the technicals to not be as overbought. Right now, I think there's just so much hype and so much anticipation that the default will be resolved, or the potential default will be resolved, that we're seeing a rally, but it's not very justified by the technicals, right? Because we've been overbought for some time now. So if we just continue to see a rally before anything is even decided, that's a very dangerous game to play, considering that nothing has been decided yet, right? So this can very well, we can very well default for a very brief time, which is going to send the market plummeting back down to at least that 313 zone. So if I were you, I would be looking at this big picture and thinking to myself, hey, we're very overbought. The best probability would be preparing for a potential short. Now, if we do end up getting the whole debt crisis resolved, then I'd be reconsidering to go into a long after we've seen that default get resolved, after we've seen price action move up, find support at this resistance level that we're at right now at that 337, 337.50 zone. And if we do see a bounce at that point, then consider a long position to continue. As of right now, though, I am still more bearish or preparing to be into a bearish position, into a short position, than I am bullish. And the reason for that is just because we haven't seen anything get figured out yet. We are very overbought. We are at a previous resistance. Technicals aren't lining up. And the data from the economic data that we're seeing released isn't really supporting the market rally that we're seeing. It's all just hype around the default being resolved very quickly before the X date, right? The closer we get, the less probable it's going to be that we're going to see that resolution, and we might potentially see a brief default. Have we ever seen that happen? Other than that 2011 incident that we saw, which was very, very close, not really. We've never defaulted on the debt, the US debt, right? So just something for you guys to consider, something to prepare for. If you guys found this video helpful, make sure to smash that like button, subscribe. We do these videos every single Monday night. Hopefully you guys gain some value, and I hope you guys have a great rest of your week.